Thank you very much, Luca, and welcome to our first panel of the day, where we're going to be picking up on some of the themes that Luca just mentioned, and also developing generally a discussion about the market, the covered bond market, and how that affects Asian conditions. After this conversation, we're going to be moving on to a more forward-looking session about the new countries which are potentially going to come on stream in the Asian covered bond market in about an hour or so on this platform. But to help me have this markets-focused conversation, we have the speakers that you see in front of you now. Let me briefly introduce them. Matthias Ebert is the head of FIG origination globally, so responsibility including Asia for DZ Bank. Frederick Kuntz is the senior analyst for fixed income at NordLB. In addition to covering covered bonds, he also has responsibility for unsecured bank bonds. Matthias Melms is the head of syndicate and origination for both FIG and SSA at Helaba being the central bank for, I think, something like 40% of the German savings bank sector. And Chris Ngoy, the head of wholesale and structured funding at DBS Bank, who of course have been one of the pioneers of covered bonds in Singapore and Asia generally. Gentlemen, thank you all for joining us. Before I ask Matthias about the state of the overall market, can I just say this recording is going to be available after we finished for about 30 days. Feel free to share it with your colleagues. And I'd also like to point out that all of the four speakers today, these from DZ Bank, NordLB, Helaba and DBS, are sponsors of this covered bond briefing, alongside Moody's, who you're going to be hearing from later, and Danske Bank. So thank you all for your sponsorship and for your participation today. Matthias, let me start with you if I can. Clearly things are in a massive state of change after a very stable few years in the European covered bond market. What's going on and how relevant is that for people in Asia?
Yeah, first of all, thank you, Richard, for the question. We have the topic that we are the first time this year for around 2 years now seen dramatic increase in issuance volume in the euro covered bond market for a specific reason. After the response to COVID from the central banks worldwide, we are now see that this year this response diminish a little bit, and banks again rely much more on wholesale funding than they did this last 2 years, especially as they took a lot of central bank monies, not only in the Eurozone, but I would say worldwide, were the possibilities for the banks to get much cheaper central bank funding. This is over. This is over now, I have to say, and you see that best in the response of the ECB, where are they now stop buying on the net basis under the APP from July on, and we still that reaction in their behavior in the primary market as they are down now from 40% to 30% of the potential deal size with their own order for the APP in the covered bond market. And looking forward from delivery July, we expect that they will further decrease their order to 20%. And after the first rate hike in July, we expect an additional decrease to just 10%. And this has consequences for covered bond issuance, at least in the euro market. Could the Eurozone issuers rely up to now to a huge degree of the support from the ECB in every covered bond deal? This support will not be there in the second half of the year anymore, only to a minor degree that is, I don't want to say irrelevant for the single transaction, but overall, it is on such a low level that we have to say every issuer is now competing for the same type of investors, more or less. And as a reaction to that, we have seen an increase in issuance levels versus swap since the beginning of the year to attract additional investor demand, and that was more or less successful. What we have observed were that on Eurozone transactions that are normally by nature the tightest transaction in the market, we have seen a lot of investors that stayed sidelined for more than 2 years now. But that has consequences overall for issuers outside of the Eurozone. As the Eurozone issuers now have to also have to offer a higher spread with that second round effects. We see that additional to the spread advantage that non-Eurozone issuers had all the time and attract investor demand beside, of course, the central banks. We now see movement into to higher spreads that not only the Eurozone but also non-Eurozone issuers have to grant to investors. And this has, of course, consequences for all issuers from the APEC region and especially from Asia that are entering the euro-denominated covered bond market. From our perspective, we think that alone from this situation, issuers have to grant a higher spread than before. Saying that, we also have to take into concerns all the new development in terms of inflation, rising interest rate, etc. on the whole market, where the APEC issuers are also influenced on. Of course, that all issuers have to be are influenced on the topic.
Thanks, Matthias. So, period of fundamental change. Frederick, how do you apply that to the Asian covered bonds specifically? You're on mute.
As Matthias correctly pointed out, there are some spillover effects from the Euro market or the Eurozone issuers, which we can also see and observe in the Asian covered bond market. Although there are, of course, some specific features of the Asian covered bonds where we talk about, for example, there has not been any large-scale purchase programs for covered bonds in Asia, so they are out of this loop. Of course, as Matthias pointed out, the second round effects are really important for the spread developments, of course. And also the funding needs are also different. We saw ECB policy, for example, did not directly impact the funding mix of Asian issuers in the sense that they did not have some kind of specific TLTRO measure in their countries. So the funding structure did not change so vastly. And so they are not so much dependent on the covered bond issuance. And so we can see that there has not come so much, because maybe the need is not the same to come to the market right now when a lot of Eurozone issuers try to come to the market before the finish line of the covered bond harmonization. So what we have seen, for example, in the case of Austria. So we see that the Asian issuers are not in the same need. And when we talk about rates and spread developments, we also can see that, for example, inflation rates are not as high in Asia as they are, for example, in Europe or the US. So the situation is, you can really compare it, but it's not similar to what we see in Europe when we talk about Asian covered bond markets. So in the very end, we are quite confident, for example, that the second half of this year we'll see more issuance from the APEC region in particular, and also from some Asian issuers here.
And so before we speak to the issuer, Matthias, presumably you agree with what Frederick and other Matthias are saying. What's the impact on how issuers should come to market? What maturities, for example, should they be looking at?
Well, the maturity question is a bit tricky this year, as in the past, with the ECB's purchasing program, we had reasonably flat credit and yield curves, and I think the whole band was open from 5 to 15 years. Now, with a steepening yield and credit curve, most of the supply is focused on the 5 to 8 year part of the curve, and that's usually a part on the curve that the Asian issuers like as well. So the Europeans are focusing on that area, the Asians are focusing on that area. And it is a sweet spot. I mean, there's a good reason for it. It's a sweet spot for investors at the moment. Nonetheless, I think there is not that too much flexibility on the issuer side. So everyone is trying to get through the same narrow window on the same part of the curve, and that sometimes creates a little bit of too much traffic, and that's why it is difficult to, or more difficult now, to place covered bonds into the market than previously. And I think for Asian issuers, it might be a challenge if they all come together. We know that from some of the Canadian banks. If all the issuers come together at the same part of the curve, that might be tricky. So a lot of planning is important, but also timing is important. And I think it's more important now than in the last number of years.
And Chris, from your perspective, you're watching the European market, thinking about how you're going to fund in it. You hear what I say? What's your perspective there?
Yeah, I think my fellow panelists have said quite a few key points here that I echo. I think from an Asian issuer such as ourselves perspective, while locally we don't have the asset purchasing programs that we have seen in Europe, but I think for Asian issuers going into Europe to issue euro-denominated cover bonds, or even in sterling, for example, benefited indirectly from the ECB asset purchase program that has been introduced during the COVID years. But in the sense that, with absolute spreads being so compressed, I think relatively speaking, for a non-Eurozone issuer, we are able to issue cover bonds at historical tight spreads compared to where we used to issue in the past. I think that has been extremely beneficial. And I like to think that we give a diversification benefit to European investors who would otherwise be, not have the ability to invest in, cover bonds that have been mostly been purchased by the central bank. Yeah.
You have you have provided diversity. You have provided spread pickup. Generally, Asian covered bonds have been phenomenally popular, given the changing dynamics in the market, and more bonds, less oversubscription. Matthias, is the love for Asian covered bonds in Euroland going to continue?
Oh, absolutely. What Asian covered bonds offers to European investor is the point A, diversification out of what should I say? A struggling continent at the moment, high inflation data, housing prices that concerns a lot of investors, and overall the Russian war against Ukraine. So Asian covered bonds are a kind of safe haven, diversification possibility, I would call it, for European investors at the moment. Saying that, when you look at historical distribution to different investor types, what you clearly see is that because of technical reasons, especially real money guys love Asian covered bonds for obvious reason. Everything equal, these covered bonds offers a pickup. Not only with AAA rated covered bonds, but better rated issues that you can find in Europe. So it is especially on that type of investors that will also buy these covered bonds in the future, as long as we have the fact that because of regulatory purposes, we have them not ECB eligible. Japanese is a little bit tricky on that because of the G10 rule. But all other Asian covered bonds are not ECB eligible. And on the other hand, we have maybe a development because of EU directive how to treat Asian covered bonds under the LCR regulation in the future. But as now we have lower demand from bank treasuries, because of this regulatory disadvantages that we have here. So to bring it to the point, European investors love Asian covered bonds, but it's more the real money guys that are still loving them. Not so much the investors that are derived more by regulatory purposes.
Okay, lots of nice words. Let's try and turn it into numbers. Are we going to start seeing a spread compression? We love a spread pickup relative to European covered bonds. Are we going to have less of a pickup? Frederick, do you want to go first?
Yeah, I can try to give some ideas on that, because I would say that that we're gonna see a new spread environment, especially when we see the ECB leaving the market, and we have a general different situation when it comes to the interest rate environment and inflation fears and the compensation for risk, and also the compensation for some kinds of way, as Matthias already pointed out, that you can use Asian covered bonds slightly differently in the sense of regulatory treatment. So there are some points here where we see there should be a natural difference between these, although we have a very high credit quality from most issuers. And so the issuer story is really strong, but in the very end, it's always a question of supply and demand. And when there's more supply in the market, less demand from the ECB buying, less spillover effects we have seen. So this has come backwards a little bit. There are more arguments that we see some slight widening of spreads than any compression here. Also, just because when we have this, especially this regulatory treatment, is one specific point, and maybe it's more reversion to more natural levels or distances between different jurisdictions, and it's not a fact that maybe we see higher risks than in Asian covered bonds, but just more or less back to normal. And back to normal means, from our point of view, that the spread difference has to be there, but this should not be seen as really bad news for issuers here, in the sense, because it's just the question of why they do the funding via covered bonds, and it's not always the case that they use covered bonds because it's the cheapest way to fund, but maybe it's a good way for your asset liability management, or to be in markets where you otherwise would not be active. So maybe it's a good story for issuers to be placed in the covered bond market in euros. The other hand, for investors, maybe there's a good point in the story that there might be a spread pickup in the very end when we are more in this normalization environment. We are just starting right now. So this are some ideas on the spread.
Okay, so to that point about the other considerations, ALM and whatever, Chris, wherever spreads go, if they go slightly wider, slightly narrower, how does that impact your decision?
Well, I mean, it's all relative, right? I think if you compare cover bonds with senior products, I mean, historically, cover bonds has proven itself to be the most dependable and reliable funding instruments, especially in times of stress or volatility. So I think even if the market direction is such that the spreads are somewhat heading, potentially wider in response to the macros environment, but I think if you look at or trying to balance out the ALM thinking between how we want to fund the book, do we want to just fully rely on cover bonds or senior? I think I would say it's a balance of both. Simply because from a cover bonds perspective, there is always a limitation from an asset encumbrance perspective. But I have to say, from a absolute cost of funding point of view, I think cover bond is still the most attractive from an issuer perspective. But we do want to maintain a balanced liability profile as well.
Right. Can I move on? We're talking in terms of euros, and I think when I look at non-European jurisdictions, there's a real divide going on. All the Koreans, all the Japanese have been completely focused on euros. Singaporeans, Australians, Canadians have gone sterling, they've gone US dollar, they've gone Aussie dollar, Swiss franc. Why is there that divide? And is it going to change? Are we going to start seeing more diversification from Korea and Japan, and less from Singapore, Australia, Canada? Who wants to answer that? Matthias.
Well, happy to jump in. Yeah, I think the Koreans have started in dollars and have been dollar issuers and covered for quite some time. Recently, they have then changed and looked at euros. I think that has a lot to do with the ultra-loose monetary policy and the purchasing programs from the ECB. if you look at dollar versus euro covers at the moment, euros are cheaper, and it's the broader investor base. And I think that is relevant for the Koreans as well. The dollar covered bond market has developed in a kind of a AAA rated product from a very well rated issuer from a AAA rated country. And the Koreans don't fulfill that. So they're not from a AAA rated country. They are they have a AAA rated product, but some of the banks are a bit weaker on the credit side. So I think if you look for diversification, if you look for a broad investor base that is willing to accept also different types of risks, then you're better off in the euro market. And on top, the market was cheaper on a currency adjusted basis versus the dollar. I mean, some of the Korean issuers like to swap back into dollars because they need dollars instead of euros. So they had the extra cost for the cross currency swap. But I think bottom line, it was cheaper and the market was more receptive for them. And that's why they moved into the euro. For the Japanese issuers, I think it is a bit different as some of them have smaller funding needs. And I think it's a strategic decision in which market you want to play. Whether you focus on the euro market, as I said, the more diverse market on the investor side, more receptive and cheaper, or whether you go into the dollar market. But even in dollars, 50% of the demand on dollar trades is coming from Europe and Asia. So I think they were better off in euros, and documentation is cheaper as well. Will that change? I guess we have to see. I think that dollar market will become more attractive going forward on a currency adjusted basis once the ECB leaves the euro market. So I think we will see how that pans out. But for the moment, I think those two issuer groups are better off in euros, and documentation is cheap as well.
Mm-hmm. Frederick, do you think it's as Matthias explains, a different story in different countries are driving that difference, or what do you see as the driver of the different approaches?
Yeah, I would totally agree with what Matthias said, that there are, of course, country-specific environments or topics why you might be interested as an issuer to go into different currencies. In some sense, you could compare Singapore more with Canada than, for example, the other two Asian countries, Korea and Japan. Because, of course, the Singaporean market is a little bit more established, a little bit more developed in the sense that the issuers are longer there, and that they have already made their history in the market to some extent, so they can go the markets which are not as deep as the euro market. How has this changed for the other countries? For example, when you look at Japan, which is working on a covered bond legislation for quite some time, this could be also some argument that investors might be more interested, and that they wait until this legislation is done, and maybe there's a more legal-based approach from these issuers. And of course, you need to do more investor work when you go to the smaller currency markets, in the sense that they are not as deep as the euro market, not so many investors which are so deep into covered bonds like in the euro market. And one point, of course, which already changed now is that we have seen in the past more or less the longer maturities mostly in the euro market. And now we come and when you need longer maturities, the euro market has been more receptive in the sense, but now we see here also shorter maturities. This could be also some impact on the other currencies as well. And of course, when there's more supply to the market in general, you maybe try to fit also to the other investors in other sub-markets. So it could also be an argument here. And of course, as was already pointed out by Matthias, of course, the question of the costs of swapping into the currency you need at the very end, and then you need very good swap rates cross-currency wise to make this deal beneficial to go to more different currencies here.
Matthias, you speak to all of these issues. What do you tell them about currency choices?
Yes, first of all, you have to see that the reason behind the choice for a currency is completely different depending on the issuer and depending on the goal you want to reach. So first of all, I know, for example, from Singaporean guys, introduction of the covered bond legislation and introduction of all the covered bond programs. There was behind that was the idea of the MAS to establish a kind of lifeline to the most functional market in the crisis. So taking this as a blueprint, it is for nearly every issuer, it is highly important to have the access to the euro market. So you have to be regularly in euro. Besides the maybe funding costs that are higher than in other markets from time to time. So, but you may have to make sure that the lines are open for you in terms of the crisis. That's overall the huge advantage of the euro market, also in comparison to nearly every other market. Besides that, your funding activity in your domestic currencies is obvious. You have the domestic currency needs to refinance your portfolio, but for that you need a domestic investor base, and that is at least at the moment something where I don't see such developed market in Asian and the APAC region as in Europe. When you could have a look at the European market besides the euro, you have the sterling market, you have the Danish krone market, you have of course the Swedish krona market, the NOK market, where domestic issuers satisfy their funding needs. But saying that, besides that, the idea of having access to domestic funding and having access to euro funding, there are a lot of banks out there. You have natural needs in not so common currencies as the Aussie dollars. Chris is for that is a good example. Correct me if I'm wrong, Chris. You have done Aussie issuance because you have Aussie needs, and there are other issuers. We have also natural funding needs in not so common currencies, and that is at least one reason, besides the relative value play, why we see always issuance in these currencies, and that's explained at least a little bit why we haven't seen issuance activities from all issuers in the Asian region, for example, in the Aussie market.
Chris, there's a huge amount for you to respond to there, and I think, please respond to
I guess, yeah. I think from our perspective, I think we like to maintain the breadth and the depth of the access, right? I mean, if we are going to be serious about covered bond market, let's make sure that we have all access points and touch points across currencies and jurisdiction. And then undoubtedly, obviously, the euro market has the deepest investor access, given that this is a home ground for covered bond. But at the same time, as the product matures, I think we would like to diversify into other currency to supplement our balance sheet funding profile. As what Matthias said earlier, we may, from time to time, we have situation where we have natural Aussie dollar needs, and instead of raising it in euro and swap it to Aussie dollars, perhaps there is an opportunity to just issue an Aussie dollar covered bond directly to investors, and giving us the opportunity to engage a new set of investors, and probably save some basis point on the swap cost as well.
It's a general thing about the domestic investor base. So when you do Aussie dollars, have you any idea how many Singaporeans will buy you in Australian dollars? And just as a more general comment, when are we going to see the first Sing dollar covered bond?
Well, I think from an Aussie dollar domestic investor support, there are some participation from the Singapore investor base, and typically maybe out of the Australia offices, simply because that's where most of the Aussie dollars are parked, right?
Yeah.
Other than that, from time to time we also see investors participation in say in Hong Kong or even in North Asia as well, to the extent that they have surplus Aussie dollar deposit to deploy. So I think there are value in terms of diversifying the currency of issuances, and it gives us the opportunity to engage with different type of investors. There are some overlap, however, but at the same time, I believe that different investors, even if they can buy in multiple currencies, they will look at each currency bucket differently, from a use of funds and source of funds point of view. And to your question about when we'll ever see the first Singapore denominated covered bond, I will lean into the non-Singaporean incorporated banks to lead the way. I think from our perspective, it will be a difficult conversation as to whether we would be issuing a Singapore denominated covered bonds, simply because there's very much less of a need to do so from the balance sheet perspective. But I would strongly encourage my peers in the foreign banks perspective to lead the way. And I think hopefully with the MAS increased, should I say, the asset encumbrance limit from 4% to 10%, that would make the whole commercial consideration a lot more acceptable.
Yeah. To the Europeans, when are we going to see a Sing dollar fan brief? Come on, pitch it, someone. Or British covered bonds or French covered bonds. Come on, there's plenty of diversification going on.
So maybe I can jump in. As soon Chris and the other guys in Singapore start buying covered bonds for their LTR portfolios, or at least for investments, and as soon as we have a relative value in Sing, so we would be more than happy to issue something like that. So please give us a heads up, Chris. Yeah. When you're ready.
I think it's a bit of a chicken and egg story, right? Someone needs to lead the way for the relative value to make sense as well as the market develops. So yeah.
Let's move on to ESG factors. One of the differentiating factors in Korean covered bonds has been the number of social or environmental labeled covered bonds. Not so much in the other Asian issuers, quite a lot in Europe. Let's start with the big question. Is it just a nice thing to do, or is it actually useful from a market's perspective? And then second question, are we going to start seeing more ESG issuance out of Asia? Who wants to go first? Frederick.
Yeah, I can take your question. So I think it's not a nice thing to have with this ESG topic. So maybe Asia is here not so much ahead of the curve in the sense that we have not seen so many not so many issues. Despite the potential is quite big. Also, for example, for Singaporean issuers, Chris may correct me later on, but at least we know that there are a lot of social housing projects, for example. So the S of the ESG would make sense, and maybe also in the sense that we already have this quite strong regulation when it comes to EU taxonomy or green bond standard. There are a lot of things happening, and it's also our belief that this is not a thing which is only happening in Europe or for the European bond markets here. So in general, investors tend to get more picky in the sense that it's not enough to have a green bond or ESG bond out or issue this as a first one to say, okay, we have done this. It's a good marketing effect, but we are more in the area of development right now where we have to have also very good stories in the sense that the issuer is ESG compliant, that all factors of the issuer are compliant with ESG topics, and it's not the case of any greenwashing or other points. So I think investors are more demanding here right now, and this will also have a push then on, or more or less a pull to the Asian issuers here as well. So I think there's a high likelihood that we will see a social bond, for example, from Singapore coming on in the next months or years, but we will see whether there will be any programs out or green frameworks here. So, but we are quite confident this is also a story for Asian issuers in the covered bond universe.
Matthias, I know that's something very important at DZ Bank, an important part close to your hearts. What do you think?
Well, I think it's different by jurisdiction. Like for the Japanese issuers, I think it might be an extra level of complexity if they would add a green angle to their actual covered bond framework, and that eventually could be a little bit or slim down, make the whole thing a little bit too complex. So some of the Japanese issuers have already issued in green, but in senior. but not uncovered yet. So for Japan, I would think that as soon as a legislative framework is out, we would also see some green issuance. That's the same in other parts of Asia or Asia Pacific. I think that the green or ESG feature has the large benefit that the investor base is increasing. I think in these difficult times that we see at the moment, where volatility is a major concern and execution is more difficult, it is a benefit for issuers if they can access a broader investor base, and the investor base broadens with an ESG feature on a bond. On the other hand, first of all, you need an energy efficiency certificate for your residential property. That sometimes that does not exist in the country, and then you need a definition what a green mortgage loan actually is, and that definition and the energy efficiency label needs to be accepted by investors or by the market. And I think that it will probably take some more time for some jurisdictions in Asia to develop both. And as soon as we see that, I think we'll see more ESG and green covered bonds.
Chris, is it something that you looked into?
Yeah, I think as a firm, ESG is obviously front and center of the agenda at the top of the house, right? I guess the question here is, if slapping a label or ESG label on a cover bond helps to achieve the strategic agenda of the firm, I think it's definitely something that we can look into it. At a deeper level, does it even involve us originating a new portfolio of green mortgages, like what Matthias have mentioned earlier? I think that is something that internally the firm will have to consider as well, to make sure that the whole infrastructure and the framework are done properly and holistically, instead of just rushing out with a ESG labeled cover bond for the sake of it.
That's something I've heard from a lot of issues, the holistic approach rather than just labeling this little bit. It's a common comment that I've heard. Matthias, what are your thoughts? Are we going to see more issuance in general for ESG?
Let me have just provide some data here. Everything equal, what we see in general is that ESG covered bonds provide higher demand from investors because you still attract investors that you maybe don't have on your traditional covered bonds because of the ESG label, and especially in a market situation like we have at the moment, where the ECB is steering on a new regime in terms of covered bonds, it gives you a kind of additional execution security. So not only from an ESG perspective, it makes a lot of sense for issuer to look maybe in the future deeper on that topic, but also from the execution strategy, it is extremely helpful in more volatile market environments as we have it definitely now, to reach your funding goals that you have. So and when you look at you mentioned it before, when you look at the Korean issuers that have issued with specific labels on it, the outcome was I think was better than it would have been without that.
Yeah. We've only got a few minutes left. There's one topic I do want to ask you, but it's a topic we have discussed a lot in the past, which is the directive. Now, as far as I can tell, Singaporean covered bonds are going to line up on the 8th of July 2024 and get the seal of approval. Do you believe that they are going to be adjudged to be equivalent for EU regulatory purposes? And Frederick, I think it was you who mentioned earlier the LCR treatment. How much difference will it make?
So it was a question for me. Okay, so yeah, it could make a big difference, of course. So first of all, I think there are some short-term effects or short-term issues here, because we have to see how, for example, issuers align with the Article 14 of the Covered Bond Directive to still be LCR compliant in the sense a third country. But in the very end, we see on the long-term scale, we see positive effects of the general harmonization approach, which provides minimum standards. And of course, especially there are issuers in Asia which are very much aligned with what is the case for the European minimum standard. So on the long-term effects should be there. There could also come some kind of push from Basel III, where we have a general preferential treatment for covered bonds. So it's not specific only for European regulations here. So we have some effects which might give some push for Asian covered bonds, but also there are some short-term cliffs which you have to manage, so that there will be no jump, will not be a bumpy ride when it comes to regulatory treatment here. As far as we can see, Asian issuers are on the way there to be aligned with it. Although we know that, especially in Japan, we know that the structure of the law is not there yet. And still, when there is a law, we still have this specific arrangement of RMBS structures, which are also not very, where, for example, the Euro system is not very happy with in terms of repo eligibility. But in general, for Korea and Singapore, where we have established laws, this should at least be a positive side effect to try to be aligned with this minimum standard. And then it's also good news for investors and issuers alike, we would say.
And Chris, you've got to do the hard work on this. TBS, I know, is leading the charge.
Yeah, I think we are part of the ECBC Global Industry Working Group. There's been quite a bit of discussions that we have within the Singaporean ABS Covered Bond Standing Committee that's been consists of the Singaporean covered bonds issuers and also potential covered bond issuers. And there's been a lot of discussion with the MES as well as to how we could work together as an industry to achieve the harmonization with the directive, and hopefully that there will be a resolution soon as well. And I think we fully understand that this is a bilateral discussion as well even at the G2G level. So I think hopefully we work towards that.
Great. We've got only a couple of minutes left, so let me just ask one nice catch-all question. We've spoken about the market as it is today. Yeah, in about a year, hopefully we're going to be in Singapore having this conference for real. What innovations are you expecting in that year? One line. We've only got time for one line each. Who wants to go first? Frederick.
I can go first. Yeah,
don't be shy.
I just volunteered. Yeah. So no, as an innovation in the market, maybe we will see from a new country or new jurisdiction a covered bond issuance. Maybe not in the Euro benchmark segment, but maybe a little bit more from India, for example, or maybe some more developed Asian country. So we will see that there are some. We hopefully see that there are some innovators in the sense that they bring forth new jurisdictions in the covered bond markets, which give us some hope, hopefully, that we will see more Euro benchmark issuances from out of Asia from more than 3 countries. So we are quite confident that this might happen. Maybe not in the next 12 months, maybe 24. So the time frame is a little bit too short, but we are quite confident that we will see some dynamics.
Okay.
Yeah, I guess from my perspective, I think I'll hope to see more Singaporean issuers other than the existing 3 at the moment coming into the market. And similarly, to the extent that the economics make sense, we would like to see foreign issuers issuing covered bond in Singapore dollars. I think that will be a good development.
And my hope is that we will see a legislative framework for covered bonds in Japan.
Matthias, last but not least.
Additional to that, we know that a lot of Asian countries are looking at the covered bond product for itself. We know that issuers behind the scenes discussing to establish covered bond programs even without a legislative base. Question is, does this make sense or not? But on the other hand, to be frank, I would have hoped in the past to moving much faster forward to that than we have it now. Besides the Singaporeans, Korean and Japanese, we haven't seen much activities yet. So fingers crossed that it will change in the very soon future.
That was actually going to be my comment. I was going to say that we are going to see new jurisdictions. They're going to be coming with structured covered bonds that might well be coming with non-mortgage assets. So in general, the development of this market is what we're going to be discussing in our next panel. In about 20 minutes or so, just got time to grab a coffee. We are going to be speaking to Colin Chen from DBS, Patuk Chung Chi Long from Chagamas, and Joe Wong from Moody's about future developments in the sector. So please stay tuned. As I said at the beginning, these sessions are all going to be available for 30 days, so please recommend them to your colleagues. Please share them. And a massive thank you to all of my panelists today for their contributions. See you in about 20 minutes. Thank you.
Thank you.